Hello traders, welcome to FreeFX. Today I'm going to discuss quite a few things, so just bear with me, I'll try and keep it short. This is video 152. It's just started the weekend. It's now Saturday, and we're going to have a fantastic week ahead. Lots of events that are going to shape possibly or possibly not the financial markets. We'll have to have a look and see also what the technical aspects are, the technicals for SPX, which is what these videos are mostly about, as you probably know by now. So let's move on to see what has been happening today, but also this week, generally speaking. So this week has been a mixed week with the Federal Reserve blackout period, sort of in preparation for the actual rate decision, the last rate decision for the year for 2022 next week. We've had obviously a dearth of events that might have given price the push it needed, although sometimes the lack of a motivator has not really, as I've shown in the previous video, stopped prices moving in the week sort of where the Federal Reserve is not having any sort of influence on market participants. But even so, you know, sometimes that happens, but even so that happens, we do generally expect that there's a sort of lull or period of stasis, kind of waiting for the big moment. So just without further ado, here is my now sort of quite interesting chart, because it is developing into what I thought it might happen. There's never a guarantee when you do a technical analysis. So it just so happens that this time it was actually shaped as it sort of predicted, if you like, if that's any predictive value to lines on our chart. But truly this week has been, and if we look at the daily as well, look at the daily action today. I'll show you what that looks like. It's this. So essentially, if we look going back to, this was the 30th of November, which is where we had the Brookings Institute talk by Jerome Powell, and this sort of happened. And then we went above the top trend line there, and we also went above 4,000, broke above, and then started breaking below again the trend line. So we had, from the 1st of December, start of the month, we've had 3, 4, 5, 6 red days. Of course, the day before is actually not a red day, but altogether 6 red days. Now, we sort of stalled around this area, which is just above 3,900. The 3,900 is actually here, so basically we're looking at this sort of area of the trend line. But it should be lower than that. Actually, it's more like here. So that means basically we have been moving lower from the start of the month, and the divergence I've mentioned on the CCI, you can see that divergence starting there in 26th of October, sort of end of October, and then on the daily, the CCI has obviously moved below the neutral line, the 0. And we're now at a negative 81, by the looks of it. Yeah. So this is all obviously reminiscent of other times, and I've mentioned this before, so I won't repeat myself too much. But if you're new to my videos, this fairly recent trend chart that I started using instead of the Bollinger Bands is because, it's not because I don't like Bollinger Bands anymore, far from it, but there's only so many things you can have on a chart. So at the moment I'm following this particular analysis, but the Bollinger Bands are very much there. So if I'm just putting them back on there for you, you can see that we're actually interestingly on the middle line there, which is the basis, and we're just sitting above that. And if we bring back the 21 moving average, weighted moving average, just basically prices sort of around these two. So not really much different. And if we put it back to the daily, see how those look compared to the daily. That's how they look. We've broken below the basis and the WMA, and we're just sitting above that lower Bollinger Band. So it's an interesting area, and if I could sort of maybe show you the 4 hour and see, on the 4 hour we have some action, because after that big candle on the 30th, we basically erased those well, gains, let's call them, if you're a long kind of trader in this scenario, and we've bounced back, but we are pushing lower. So currently we are lower than we started on the 30th of November when that move happened, and we're pushing to these lows here, which are just kind of coming up to 3,900. So that is the situation. On the CCI, we've kind of hit the level of minus 131.43, and we've hit the minus 200 twice, so we're kind of heading back below zero. We crossed the zero and we're heading lower. Now the minus 131.43 is significant because, I'll go back to a higher time frame. If we go to the weekly, that is a significant level, but I think actually that might be something like the monthly, I believe. Let me go and check. Yes, so on the monthly, that level is the level that we hit in 2016 when we dropped, and is basically the level that we sort of hit here, okay, in October. So on the monthly, and very close to the 2020 there as well. So it's a sort of rough line there to say that these levels on the monthly are quite rare to see, and are sort of like could be a turning point. Now, not to say that we couldn't turn lower, because this sort of V-shaped is not what we've got now. It's not a V-shaped situation. It's a slow basically move lower. And if you look to the 2008 again, I've done this plenty of times now, you'll be used to my looking back to 2008. We had this coming towards these levels, bouncing like we're doing now, bouncing, but we did move lower eventually, sort of, and that created even further panic selling. So it is possible that may happen, but we don't know that for sure. So I'm just going to go back to my weekly, just kind of to show you that we've had this move lower, and the CCI, as I said before, it would do, but actually it just so happens that I was right on this occasion. Not any predictive power to that, but it is turning lower, as you can see, and that means that we have essentially a very reliable situation on our hands. So what better than to follow that and sort of continue lower. But the main thing about this is that you know, from a technical perspective, we've got lots of things to talk about. So let me actually go through them in order, because it might be worth doing that just as we go through technicals and then go to fundamentals. And the next technical level that I'm going to look at is on this chart. So this is my so what we see was TradingView, and this is my broker's platform, Owanda's platform, with a few extra indicators which I cannot have on the TradingView, so I kind of use both to use different indicators. Also keep the charts from getting suffocated by too many things. Here you got the Bollinger Bands, again same values, 21 days or 21 period moving average, and what we've got here is I'm just gonna zoom in. On the top layer we've got the moving averages, 200 and the 100, so that's the 200 there, and that's the 100. So I haven't mentioned those because I haven't got them on TradingView, but essentially the 200 is what we crossed on that 30th of November Powell speech, and we're back below it, but we're also still just pressing on the 100 and just above. So you know, it's an interesting area, so to speak, because if you're trading this, it's very difficult and exhausting, frankly, but it's interesting in the sense that you know, technically those two moving averages are just averages, but also visually, obviously, it's quite convenient to sort of have them on, because certainly 200 is saying to us that we're still below that. They essentially have been for a few months now, so that still hasn't been broken. But looking further down, what I'm interested in as well is that we have this is the CCI, we looked at that, the ATR. The ATR, now a few months back, if you remember, maybe not, but I used to have two things on a chart. One was the ATR and the VIX, and I was keeping an eye on those because I'd sort of identified the areas where the ATR and the VIX have been above certain levels. So I think the main levels were 70 for the ATR and 20 for the VIX. The VIX essentially has not really moved that far higher. So, but when it did, it was interesting because that's sort of kind of where we started getting some traction on the next sort of leg down on the SPX. And in terms of the ATR, it was above 70. So if we look through the year, from the start of the year, which is about here, I think, yes, the ATR started rising and it got to about 70 here, okay, and then it sort of climbed higher and then climbed higher still. So 70 plus is when things really kick off. Then it sort of started dipping, okay, so it remained elevated, essentially is what I'm trying to say. Then it started rising again, and we got this second leg here in March, April, and May into June here. So it reached a peak of, what's that, 108, I think it was, yeah, 108. Then started coming down lower on that so-called summer rally, and we got down to 70 again. And then it bounced off the 70 and we got the next leg down. So what is significant about this is that we are now at these levels. Essentially, we're currently at 67, okay, 67.9. So not very far, and we've dipped so far, and we need to see this kind of rising higher again so that we can actually obtain some traction. And that's very important. So the ATR is at an important point. If you see that line running through to here back in August and to here back in April, it's a very important point. The 70 level has been for a few months, and here as well, the 70. Now the next two indicators are also very important because the ADX is the average directional index, and it's basically the average of the bullish momentum and bearish momentum, or positive and negative. And it's an average. So instead of telling you that there's momentum to the upside or the downside, it's just telling you that there is momentum with an M, capital M, or lowercase m, nothing else. So the momentum could be to the upside or the downside. But what's significant is that momentum rising means obviously that there's going to be some movement in one of the two directions. Now, since we reached these levels in October, to 3.5 something, 3.500, etc. Essentially, the directional index, the ADX, has started tapering off, and we've reached these very, very, very quiet levels that we haven't seen almost since back here in January. Okay, so it's this kind of long slope. It's telling us that there isn't much momentum. There isn't much momentum. And we need to see some momentum returning. Okay. Now, the momentum in this case should give us a move lower. So we just kind of have to wait and see what happens with that. And finally, the AD, which is the advanced decline, the number of stocks rising minus the number of stocks declining. Okay, and that essentially tells us how many. What is the health of a financial asset like the S&P 500? What is the health of a rally? And if you look at the rally back in the summer, we had some advancing stocks, net advancing stocks, and then as we look at that now, you can see that it's actually been declining since August. It's been declining. It picked up a little bit here in October and it's been declining now. So the current value is 0.5, and we've had these values back in March. So how predictive is the value of the advanced decline? Well, we were having this big leg down here from 4,700 down to the middle of June, which is basically like a yearly low, 3,650. Okay, so just I repeat that. So from 4,700 to 3,650. Okay, so that's like 1,000 points plus. And all the while we were having essentially the advanced decline rising all the way through that, or kind of rising a bit, but certainly not going lower. And then as the index kind of picked up, there was more of that, and then it started going lower there. So this phase seemed to be contrarian. This phase now as well seems to be contrarian to that uptick. So we just have to wait and see what happens. It doesn't seem to be the strength behind that rally there, so we have to sort of go and think of other factors that might help us determine the health of a particular move. The other thing I was going to mention was, so we looked at the technical analysis on this chart, and I'm going to obviously look at the open interest heat map. Okay, so I was looking at this because just a few videos ago I was talking about the 3900 level cluster and the 4100 level cluster, and on options it seems to have been like that for a few weeks, but obviously it's a changing landscape always. So I was looking around levels. So current levels, we're around 3900, 3800, 3700. I was going down all the price scale, thinking there'll be some open interest change that is significant enough for me to pay attention to. But actually there wasn't anything for quite a distance until we got to this 3320. And if you look at the open interest change for puts, it's 41,399. So to give a sense of scale, I mentioned a few videos ago numbers, in the 4 digits, like 5,000, 4,000 kind of change. This is 41,000. So, and if you look around this chart, all the other sort of changes, they're looking in sort of 2 digits, 3 digits. There's a 4-digit change there of puts at 3540 going forward. But the biggest is definitely this one by a mile. And this 3320 intrigues me because, if I sort of mentioned it before, but 3320 is, if I just shrink this a little bit, so this target that I've reviewed, because it was 2 weeks back, so I put it forward 2 weeks, if it was 3 weeks back, it was here. And so from the point of the arrow there, 7 weeks, starting this week, takes us down to this level. And this level is 3328 roughly, which is incredible because it's exactly the same level as the one we just spoken about. So it's surprising, but also maybe there's some sense in it from a technical stroke sort of analytical point of view and market making point of view, but certainly that's a number to watch. In terms of the Fed itself, in December is one of the quarterly events where there are economic projections, so forecasts, and then we've got the actual rate decision and we have a press conference. So there's a lot of stuff to get through and to digest. Some of it will be digested slowly, like a big potato dish, and some of it will be fast food, digested very quickly. So whatever comes out, I don't want to get too metaphorical here, but it could be not so clean. because we have essentially a lot of events next week that could sort of stagger the response that we see in price because of all these different bits of data. So and what the press conference will reveal is how much the Federal Reserve is sort of aware of what the stock market is doing and what it is paying attention to, and then try to reinforce their own message of what the Federal Reserve members are paying attention to. But it's a bit of a sort of war of words, really. What we need to see is whether there's any change from the expected as well, which is economic forecasts, projections, and inflation, etc. From the point of view of a surprise element, unlikely, because if you look back to the Fed Watch tool, if you look back to a month ago, 50 basis points was at 56.8%, and it's increased to 77%, although like a week ago was 78 point something. So, but essentially it's gone up, and the chances of a 75 basis points or 0.75% rate hike, the chances of that have gone down dramatically from 43% a month ago to now 23%. Tiny bit higher than a week ago, but essentially a very, very small percentage. Now that means that the sort of the collective is essentially heavily skewed towards this, and it's not really ready for a big surprise where maybe 75 basis points might be suddenly out of the blue put on. And I think the brief response would be very, very, very sharp. But then the rhetoric and the press conference and everything else might tone it down, because maybe if they say, well, we've used this bit of, this last opportunity to reload, front load another heavy, sort of aggressive rate hike, but we are then going to slow down from January. So we have to see what the rhetoric is going forward as well. It's not just about that one rate hike, it's about everything that goes forward from there. But if they had a 75 basis points, which is very unlikely at the moment, and then kind of an aggressive rhetoric to really reinforce their objectives, I think that would be a really, really, really heavy situation. So on that point, we looked at the options heat map, we've looked at the Fed watch tool. I would take you to the economic calendar, which is kind of the last thing to look at really today. So on the Tuesday, we've got the European Economic Sentiment Index, but for the US, 1/2 we've got the CPI, core inflation and inflation. This is kind of what's this is kind of what's moved markets before, and it can be a market mover, but the core inflation rate is expected to be slightly lower than previous, and that's the core, and the sort of headline inflation rate, it's 7.7 was previous, and that was the surprise from 8.2 I think it was, and then it's forecast at 7.3. So 7.3 will be a 0.4 reduction. Now if the PPI today was a bit higher, the PPI today was a little bit higher than expected, not by much, but I think it was 0.4, expected 0.1 or something like that. So if this came out back to the 8 point something, which may not, but if it's not a significant update, or if it just meets expectations or whatever, it may not be enough, because the next day literally is the FOMC rate decision, with, as I said, everything goes with that. So it may be a muted response. The 15th, so that's the Thursday, we have the ECB, European Central Bank rate decision, and that is also expected to be 50 basis points. Okay, so similarly to the Fed, not very aggressive, but still, we'll take the euro from years of being 0.08 to now 2.5, which is, a significant change. We've got the press conference as well, retail sales in the US, and then to finish it all off, on Friday next week we got the core inflation rate. Again, that's for the European area. So I'm just putting the European stuff as well because there's the euro playing against the dollar, and that sort of battle has a heavy influence on the dollar index, which is a basket of currencies. So you know, if the euro goes up significantly, the dollar will come down, and that could be stock positive, and all the rest will follow from there. So important to have a to keep your eye on that. Going back just for a moment to this, so on Twitter there is Michael Kramer, and he's put on this analog, as he calls it, from 2008, and as one for the SPX as well as one for the VIX index, volatility index. So I think it's very important to consider this analog because it really gives us a sense of where we are at the moment. So let me just see if I get, there we go. Now if I just click on that to give you a better view of this, you will notice that there's quite significant similarity between the two. So the VIX in 2008 obviously is the blue, and we are just coasting along this bit lower, and then we just ticked up, as you can see there. We're at 22.83, and you know, we're just ticking up. Now all this big jump is quite significant, and it really would, you know, up to the 80s would really signify a kind of like a tumble in assets. So it's a violent and sudden charge up, but for that we need something quite big. So we've had the FTX scandal and collapse. We've got you know, firms associated with FTX and NFT tokens, you know, closing or declaring bankruptcy, etc. So there is a liquidity problem there. How contained it is, I don't know. We also have the Ukraine conflict still ongoing. There's winter coming and prices will go up. People will spend less, so the inflation might come down, but it also signals that there are lots of things that would trigger a sort of recessionary type of force on the job market, on the economy. And we've got one of the deepest 10-2 spreads. So the yield inversion, the yield curve has inverted quite significantly and deep. We're in the minus 80s at the moment, so that's a really deep recession signal. And you know, a recession has an impact not just on Main Street but on Wall Street as well. So, but that's a macro theme, so we can't really time that. It could be another quarter or two before it's felt through the system. I'm going to finish there by thanking everybody for taking time to watch this video, and please like and comment. I'd appreciate it, as I'm doing this in my own time. And if you have any comments, I also like to say that I've got more of my interviews with traders coming up, so keep an eye on the channel because there's some more content in that area coming up. So thanks very much, and I'd like to wish you a great weekend, and I'll see you in my next video next week. Take care, and all the best.